Imagine waking up every morning knowing that your bills are covered, your expenses are taken care of, and you have the freedom to pursue your passions without worrying about money. It's not a dream. It's simply living off dividends. But how? How can you live off dividends, generating a steady income without punching the clock? In this video, we'll be diving into the fastest way you can achieve just that. Welcome to MoneyWise Investor, your trusted source for financial information. The idea of generating income without actively working might sound too good to be true, but it's a reality that many investors have achieved through dividend investing. By building a portfolio of dividend-paying stocks and funds, you can create a passive income stream that can cover your living expenses indefinitely. Now, you might be thinking, okay, how much do I need to live off dividends? Well, let's break it down. To generate $2,900 per month, or just $35,000 annually in dividends, you'll need a portfolio that yields around 4% in dividends. That means you'll need a portfolio with roughly $875,000 to achieve that level of passive income. Sound like a lot? Don't worry. We've got tested and proven simple strategies that can help you get there faster than you think. And the best part? You don't need to be a Wall Street whiz or have a massive inheritance to make it happen. But before we get into these strategies, let's talk about why dividends are such a game changer when it comes to financial freedom. Let's start with the basics. A dividend is a portion of a company's earnings paid to its shareholders. It's essentially a way for the company to share its profits with investors. When you own shares of a dividend-paying stock or fund, you'll receive regular cash payments based on the number of shares you hold and the dividend rate. For example, if a company pays a $2 annual dividend and you own 100 shares, you'll receive $200 in dividends over the course of the year. Now, the dividend yield is an important metric to understand. It's the percentage of a stock's price that is paid out annually in dividends. So if a stock is trading at $100 and pays a $4 dividend per share, its dividend yield would be 4%. Higher dividend yields can be tempting, but it's crucial to consider the sustainability of those dividends. A company with a sky-high yield might be struggling to maintain those payouts, which could lead to dividend cuts or suspensions down the line. That's why it's essential to look at factors like a company's payout ratio, which shows how much of its earnings are being paid out as dividends. A payout ratio below 60% is generally considered safe, while anything above 80% could be a red flag. You'll also want to examine a company's history of dividend growth. Consistent increases in dividends over time can be a sign of a healthy, well-managed business. And don't forget to diversify your portfolio across different sectors and industries to mitigate risk. Now that we've covered the basics of dividends and how they can provide a steady income stream, you might be wondering, how can I actually achieve my goal of generating $2,900 per month or $35,000 annually from dividends? Well, as promised at the beginning of this video, we'll be revealing to you 3 simple yet powerful strategies that can help you turbocharge your dividend income and get you to that target faster than you might think. Starting with 1. Covered call ETFs. One strategy to supercharge your dividend income is through covered call ETFs. These funds sell call options on the stocks they hold, generating extra income on top of the dividends paid by those stocks. Here's how it works. Let's say the fund owns shares of a particular company, currently trading at $50 per share. The fund could sell an option, giving the option buyer the right to purchase those shares at a predetermined price, like $55 by a certain expiration date. In exchange for selling that option, the fund collects a premium up front. If the stock stays below $55 by the expiration date, the fund gets to keep the premium as income, on top of any dividends paid by the company. This option strategy, known as covered call, allows the fund to generate extra income while still participating in the stock's upside potential, up to that $55 strike price. Covered call ETFs, like the Global X Nasdaq 100 Covered Call ETF, or QYLD, and the Amplify YYY ETF, are designed to provide higher income streams than traditional ETFs or mutual funds, thanks to this options writing strategy. However, it's important to note that covered call ETFs may underperform during strong bull markets, as the call options sold can cap their upside potential. But for income-focused investors, the consistent stream of income from these funds can be a valuable addition to a diversified portfolio. Number 2. High-yield REITs. Another avenue to pursue higher dividend income is through real estate investment trusts, or REITs. These are companies that own, operate, or finance income-producing real estate properties, like apartments, shopping centers, office buildings, and more. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This unique tax structure often leads to higher dividend yields than you might find with traditional stocks. For example, the Vanguard Real Estate ETF and the Realty Income Corporation both offer dividend yields well above the average for the S&P 500. But why are REIT dividends so attractive? Well, think about it. These companies generate steady income from rental properties and leases. As long as their properties remain occupied and cash flow remains consistent, REITs can continue dishing out those juicy dividends to shareholders. Of course, like any investment, there are risks to consider. REITs can be sensitive to changes in interest rates and economic cycles, which can impact property values and occupancy rates. But for income seekers willing to weather some volatility, the higher yields offered by REITs can be a compelling addition to a dividend portfolio. 3. Dividend Aristocrats. If stability and reliability are high on your priority list, then the Dividend Aristocrats might be right up your alley. These are companies that have increased their dividends for at least 25 consecutive years, showcasing a rock-solid commitment to rewarding shareholders. Names like Coca-Cola, Procter & Gamble, and Johnson & Johnson are part of this elite group, having consistently grown their payouts through good times and bad. So, what's the secret behind the Dividend Aristocrats' success? Well, these companies tend to be large, well-established businesses with strong competitive advantages and steady cash flows. They operate in relatively stable industries and have a proven track record of profitability, even during economic downturns. By consistently increasing their dividends over such a long period, the Dividend Aristocrats demonstrate a commitment to returning value to shareholders. And for income investors, that reliability and consistency can provide a peace of mind, knowing that your dividend stream is unlikely to be disrupted by temporary setbacks or market fluctuations. Of course, investing in individual Dividend Aristocrat stocks can be time-consuming and risky if you don't diversify properly. That's why many investors choose to gain exposure through low-cost ETFs, like the ProShares S&P 500 Dividend Aristocrats ETF, which provides a diversified basket of those elite dividend payers in a single investment. These strategies are all powerful tools for generating an attractive stream of dividend income. But there's one more key concept that can truly supercharge your results: compounding. See, when you reinvest your dividends by using that cash to purchase additional shares, those new shares will then generate even more dividends, which can be reinvested again, and so on. Over time, this compounding effect can turn a modest initial investment into a substantial income stream, all without you having to contribute additional capital. Let's look at a hypothetical example to illustrate the power of compounding. Imagine you invest $10,000 in a dividend-paying stock or fund with a 4% yield or $400 in annual dividends. If you reinvest those dividends to purchase additional shares each year, after 10 years, your portfolio could be worth over $14,000, assuming a 7% annual growth rate. Fast forward to year 20, and your initial $10,000 investment could now be generating over $1,400 in annual dividends, based on that same 4% yield. And by year 30, your portfolio could be worth a staggering $40,000, throwing off over $1,600 in dividends annually. That's the magic of compounding. Your money grows exponentially, as your reinvested dividends earn dividends themselves. It's a virtuous cycle that can turn even modest investments into a steady income stream over time. Of course, this example assumes a consistent dividend yield and annual growth rate, which may not always be the case in the real world. But it illustrates the powerful potential of reinvesting your dividends, especially when you start investing at an early age, and gives that compounding more time to work its magic. Living off dividends isn't just a pipe dream. It's an achievable reality for those willing to put in the effort and follow a disciplined investment strategy. By combining tactics like covered call ETFs, high-yielding REITs, and Dividend Aristocrat stocks, you can build a diversified portfolio that generates a steady stream of dividend income month after month, year after year. And when you harness the power of compounding by reinvesting those dividends, you unlock the potential of exponential growth over time. So if the idea of waking up each morning knowing your bills are covered and your financial future is secure sounds appealing, it's time to get started on your dividend investing journey. If you found value in this deep dive into living off dividends, be sure to give this video a thumbs up and share it with others who might be interested in exploring this income strategy. And if you're not already subscribed to our channel, hit that subscribe button now. And turn on notifications so you never miss our latest money tips and investing insights. Thanks for watching, and until next time, stay money-wise.